Hi, Larry Gaines, Power Cycle Trading. Well, we're almost at the end of the year 2014, and I wanted to show you a really interesting and kind of creative trade setup that I like to look at using. And this is one on Tesla. This was back in August the 1st, 2014, and it's a deep in the money bull put credit spread. So it's what I call a bullish price target option strategy, and it's got a really fantastic positive risk ratio. And the way that's done is because it's so deep in the money when the credit spread is done. So this is one of my favorite credit spreads really to teach. And this is basically a look at one of the setups on Tesla earlier in the year to show you how powerful this can be. So here's the chart looking back at Tesla. This was back in August. So you can see here it had been in what we call a volatility compression squeeze. So when my model is programmed to show the squeeze based on the rules of our trading system. So these dots represent when a squeeze starts and when it ends. So what we're then looking for is, okay, is it going to break hard to the upside? It's like a spring being coiled. Eventually it's going to break either up or down. So using our trading model, cycle 1 indicators and 2 indicators, it'll give direction based on momentum, and the momentum's up here on 1 and 2, so the probability was for it to break to the upside. So a couple things you can do. You can either look to, just to buy the shares outright. At that time, they're trading around $229, $230 a share. So you could buy shares outright. You could buy long directional calls outright. You could buy at the money calls, in the money calls, out of the money calls. You could buy a call debit spread. A lot of different things you could do. But the other thing that you could have done here is an in-the-money bull put credit spread, and this is what the risk ratio looks like on that trade setup. Now the beauty of this particular type of setup is that you're selling a deep in the money put, and then you're buying a put below it. So it's a hedged trade, and on this particular situation, Tesla was trading around 229, 230. This was selling the 240 put, buying the 237.5 put. So it's a bull put credit spread. So if the market goes up, this will profit. It's a $2.50 wide spread. So the difference is your credit received, 217.50. The difference in the spread, 250 minus 217.50, gives you an at risk of 32.50. That's the beauty of this type of structure. So you have a very low capital at risk with a very potentially high return on capital of that 217.5 credit or whatever you can keep. So at the end of the day, this lasted for 7 days. When it expired, this had a potential to make over close to 600% return on capital because you had such a small amount of capital at risk. So hope this enlightens you a little bit on other trading type opportunities, and talk to you on the next video.